All right, let's get started. Today, we're going to lay down the foundation for something really powerful: financial accounting. It's basically the language of business. So, if you've ever been curious about how companies handle their money or make those big decisions, well, you are in exactly the right spot. We're starting from scratch, right at ground zero. So, here's what we're going to cover. First, we'll tackle what accounting actually is and why it even exists. Then, we'll dive into the one big rule that underpins everything. After that, we'll introduce the five key building blocks, see how they work in the real world with some examples, and then wrap up with the most important stuff you'll need to remember for your exams. Sound good? So let's kick things off with a big question. What is accounting? The easiest way to think about it is as the language of business. Seriously, it's the system a business uses to keep track of its money, make sense of it all, and then communicate its financial story. And just like any language, the whole point is to be clear. And that whole storytelling process really breaks down into four main steps. First, you have to record every financial event that happens. Then, you summarize all that data so you can actually see what's going on. You note the big picture. From there, you analyze it to figure out how the business is doing. And lastly, you communicate that information to people who need to know, like the owners or maybe a bank. Okay, but here's a really important rule you've got to get straight from the beginning. Accounting is picky. It only pays attention to things that can be measured in money. So, for example, if a business pays rent, yup, that gets recorded. If it buys a new van, that's recorded too. But what about things like how skilled the employees are or how happy the customers are? As important as those things are, you can't put an exact dollar value on them, right? So they don't go into the accounting records. This rule is what keeps everything consistent and trustworthy. All right, now we're getting to the absolute heart of accounting. This is probably the most important concept you'll learn. I like to call it the rule of two. And the idea is simple. Every single thing that happens in a business has two effects, always. Nothing happens on its own. The official name for this is the dual aspect concept. It just means that for everything a business gets, it has to give something up. The getting part is what we call a debit, and the giving part is the credit. Now please remember this. Debit and credit do not mean good or bad. They're not plus and minus. They're just like left and right or up and down. They simply show the two sides of the coin for every transaction. And here's how we see that concept in math form. It's called the accounting equation. It's super simple. What the business owns, we call those assets, has to equal what the business owes to other people, those are liabilities, plus what the owner has put in themselves, that's the capital. This equation is the golden rule of accounting. It always has to be in balance, no exception. Let's watch it in action with a super simple example. Say you start a business and you put in $10,000 of your own cash. Okay, what happened? Well, the business now has $10,000 in cash, so its assets go up by that much. But at the exact same time, your investment in the business, the capital, also went up by 10,000. And look at that. Assets of 10,000 on one side equals capital of 10,000 on the other side. It's perfectly balanced. Okay, so we know every transaction has two effects. But effects on what? Well, here's the cool part. It turns out that everything that happens in a business affects some combination of just five basic categories of accounts. Just five. Think of them like Lego bricks. If you understand these five building blocks, you can basically understand any business transaction out there. First up, we have assets. These are basically all the valuable things the business owns or has control over. You know, stuff like delivery vans, the products on the shelf, we call that inventory, cash in the bank account, and even money that customers owe the business from a sale. We have a special name for that last one: trade receivables. All right, next up are liabilities. These are the flip side of assets. It's not what you own, it's what you owe. These are the debts and obligations the business has to pay back to other people. Think of a bank loan, or maybe money you owe to your suppliers for stuff they delivered. We call that one trade payables. Building block number 3 is capital. We already met this one in our equation. It's just the owner's own stake in the business. It's the money they personally invested to get the whole thing off the ground. It's their piece of the pie, so to speak. Number 4 is revenue. This one's pretty straightforward. It's the money the business earns from doing what it does every day. So, if you're a coffee shop, it's the money you make from selling coffee. If you're a tutor, it's the fees you get for your lessons. It's the income. And our 5th and final block, expenses. You know the saying, you gotta spend money to make money? Well, that's exactly what expenses are. They are all the costs of running the business and earning that revenue we just talked about. This is your rent, your staff salaries, the electricity bill, all of it. So, how do debits and credits fit in with these 5 blocks? This chart right here is the cheat sheet, and I want you to look for a pattern. To make assets and expenses go up, you debit them. For the other 3, liabilities, capital, and revenue, to make them go up, you credit them. See that? If you can remember that assets and expenses are the debit team, the rest will fall into place. It's way easier than just trying to memorize random rules. All right, that's enough theory for now. Let's make this real. The best way to get this stuff to stick is to see it work. So let's take these rules and apply them to a couple of everyday business situations. Okay, example number 1. Let's say the business buys $500 worth of goods that it's going to sell later, and it pays in cash. Simple enough. So just think for a second. What are the 2 things happening here? What are the 2 accounts that are affected? Ready? Let's break it down. First, the business's purchases went up, right? It has more stuff to sell. And purchases are an expense, so to increase an expense, what do? We debit it. That's one side. The other side is that the business used cash to pay for it. Cash is an asset, and it just went down. To decrease an asset, we credit it. So there you have it, a debit of 500 and a credit of 500. Perfectly balanced, just like it's supposed to be. Okay, let's try another one, this time with a little twist. The business sells $800 of goods, but the customer doesn't pay cash. They promise to pay for it later. We call this a credit sale. So, what do you think the 2 effects are this time? Here's the breakdown for this one. First, the business made a sale, so its sales account, which is revenue, went up by $800. And our rules say to increase revenue, we credit it. Cool. But what's the debit? We didn't get any cash. Well, what we got was a promise from the customer to pay us. That promise is something valuable the business now owns, so it's an asset. We call it trade receivables. And since that asset increased, we debit it. And there it is again, a debit and a credit, perfectly balanced. All right, as we start to wrap up, let's zero in on a few key points that you absolutely have to know, especially when you're thinking about your O-level exams. Honestly, getting these fundamentals down is half the battle. Let's just quickly nail these down. First, always remember, purchases are an expense. It's a cost of making sales. Sales, on the other hand, are your revenue. Now, if the owner takes cash out of the business for themselves, we call that drawings, and it lowers their capital. If you give a customer a discount, that's a discount allowed, and it's an expense to you. But if a supplier gives you a discount, that's a discount received, and that's treated like income. And one last thing, if a customer never pays what they owe, that's a bad debt, which is another type of expense. You know, the famous investor Warren Buffett once said that accounting is the language of business, and he's spot on. Just like learning Spanish or French, it has its own grammar and rules. Everything we've covered today, debits, credits, assets, liabilities, that's the basic grammar you need to start reading and understanding the financial story of any company. So, what's the big takeaway from all this? It's pretty simple. If you can really get your head around these core ideas, the rule of 2, that accounting equation, and the 5 building blocks, you've unlocked the first and most important level. You're doing more than just studying for a test. You're learning how to speak the language of finance. And once you can do that, you can start to understand how any business, anywhere in the world, really works.